On November 2, 2022, the world of crypto watched in disbelief as the stock market-style ticker for FTX suddenly flashed red, and a once unshakable empire crumbled in minutes, exposing a house of cards built on promises of ethics and transparency that had hidden a staggering theft of billions. Sam Bankman-Fried, the charismatic 30-year-old founder who had spent years preaching defective altruism and risk-adjusted philanthropy, was now the face of the most spectacular financial fraud the digital age has ever seen. The story began in 2017, when a lanky Stanford dropout named Sam Bankman-Fried launched Alameda Research, a quantitative trading firm that quickly amassed billions in crypto assets through aggressive arbitrage. In the same year, he founded FTX, a futures exchange that promised low fees, lightning-fast execution, and a user-friendly interface for both retail traders and institutional investors. By 2020, FTX had secured a $900 million Series B round led by venture giants Sequoia Capital and Paradigm, catapulting the company into unicorn status. The narrative was flawless: a brilliant, ethically driven entrepreneur building a platform that would democratize finance and fund global good. FTX's meteoric rise was fueled by a relentless marketing machine. High-profile endorsements from sports stars, celebrities, and even the NBA's Miami Heat turned the brand into a cultural phenomenon. The exchange's native token, FTT, surged from a few cents to over $80, promising investors outsized returns. SBF appeared on talk shows, championing crypto as a force for good, while donating millions to pandemic relief, political campaigns, and academic research. The public persona was that of a savior-like figure who could reconcile the wild volatility of digital assets with a genuine desire to improve the world. But beneath the glossy veneer, warning signs began to surface. Industry insiders whispered about the opaque relationship between FTX and Alameda Research. The two entities shared the same leadership, office space, and, crucially, balance sheets. Regulators in the United States and the Bahamas, where FTX was headquartered, raised concerns about the lack of clear segregation between customer deposits and the firm's own trading capital. A leaked internal memo in early 2021 revealed that FTX's risk management team was deliberately sidelined when Alameda requested large loans to cover margin calls, effectively turning customer funds into a revolving line of credit for the hedge fund. The first public crack appeared in late 2021, when a journalist from a leading financial outlet questioned the valuation methodology of FTT. Critics argued that the token's price was artificially inflated by a circular trading scheme. FTX used its own balance sheet to purchase FTT, driving up demand and creating an illusion of market confidence. Though SBF dismissed the allegations as market manipulation myths, the seed of doubt had been planted. The final domino fell on November 2, when a surprise tweet from a rival exchange's CEO hinted that a sizable portion of FTX's balance sheet was tied up in illiquid assets owned by Alameda. Within hours, a massive withdrawal surge over $6 billion in a single day sent shockwaves through the platform. FTX's liquidity pool, which had been advertised as deep and secure, evaporated. Customers watched in real time as their accounts displayed red numbers, their digital wealth disappearing before their eyes. By the end of the day, the exchange halted withdrawals, and the bankruptcy court in the United States filed an emergency petition to liquidate the company's assets. The collapse revealed the full extent of the fraud. Investigators discovered that FTX had commingled billions of dollars of customer deposits with Alameda's high-risk trades, using the funds to cover losses, fund lavish personal expenditures, and even purchase real estate in the Bahamas. Internal emails showed SBF repeatedly assuring investors that the platform was fully collateralized, while privately acknowledging that the firm was operating on a thin line. The total misappropriated amount is estimated to exceed $8 billion, making it one of the largest thefts in the history of finance. Legal repercussions followed with ruthless speed. In December 2022, the U.S. Department of Justice unsealed an indictment charging Sam Bankman-Fried with multiple counts of wire fraud, securities fraud, and money laundering. The Bahamas Financial Services Authority revoked FTX's operating license, and the company's former chief technology officer was arrested on charges of obstruction of justice. A sprawling Chapter 11 bankruptcy case began, involving more than 130 creditors and an estimated $13 billion in assets to be liquidated. The court appointed a restructuring specialist to untangle the tangled web of corporate entities, a process expected to take years. The aftermath rippled throughout the broader crypto ecosystem. Prices of Bitcoin, Ethereum, and countless altcoins plummeted, erasing trillions of dollars in market value. Institutional investors, already wary of regulatory scrutiny, retreated from the space, prompting a wave of tighter compliance measures across exchanges. In the United States, congressional hearings called the Crypto Collapse convened, where SBF was forced to answer for his actions before a panel of lawmakers. The hearings highlighted a glaring regulatory gap: the ability of a private, largely unregulated entity to hold and move billions of dollars without oversight. For everyday users, the fallout was personal and painful. Retail investors who had trusted FTX with their life savings saw their holdings vanish, while small businesses that had used the platform for payroll and invoices struggled to stay afloat. The narrative of crypto as a democratizing force gave way to a more sober reality. Without robust safeguards, the promise of financial inclusion can quickly become a nightmare of exploitation. Yet the story also sparked a renewed push for accountability and reform. Subscribe to The Collapse for more stories like this.